Every once in a while, I notice in Discord, especially in the Discords last year when you had a lot of new traders coming in, they like to play options before earnings. And I have completely written this off from my repertoire years ago because it just doesn't work. And I want to talk about why it doesn't work. And this is how it conceptually doesn't work for me. Now, a lot of people, they want to play. What I find people want to do is they want to play a company's earnings because they like the company. They have some kind of affinity for it. They use the product, or they hate the company and they think that this earnings is going to finally show how they hate it is going to work. It's a guess. It's a gamble, and I'm not in this to gamble. I will say that I speculate, but I'm not trying to gamble. I don't even like going to Vegas. But playing options before earnings is a gamble, and it's not even a very good one. Let me just simplify it down in terms of probability. So, what do you need to win on an earnings play? Let's say that you're going to buy a call or a put right before earnings, the day before, because you think the stock is going to do whatever. Well, if you buy a call, you're betting on it going up. If you buy a put, you're betting on it going down. It can only do one of those two things. So to start with, your probability is going to be 50-50. You have a 50% win rate just to start with. Coin flip. Now, if you think that you know what it's going to be, well, you don't, unless you're getting insider information, and that's illegal. So let's just dispel the notion you think it's going to be. It's just a coin flip. And I've seen so many cases where a company blows earnings out of the water, and then they get on their earnings call and the stock tanks because they said something dumb, or they had bad guidance or something to that effect. You just don't know. And even if it's good, the stock can still drop. Or even if it's bad, they can have great prospects for the future and it goes up. Absolute crapshoot, flip a coin. So if it was just 50-50, then maybe we'd be okay winning. But right before earnings, implied volatility gets jacked up because there's an event coming. There's a binary event. There's a shock coming to this stock. There's an actual catalyst that can move it. And so what happens is options price in an expected move. The market, based on the options pricings, expects how much it's going to move. Now, that can be 1%, 2%. It's going to be dependent on the stock, going to be dependent on what news and buzz there is, but it's all reflected and it can be statistically measured in implied volatility through the options. And so the options, they get more expensive to encompass this expected move. And then when the event happens, down comes that implied volatility because it's been realized. So in order for you to win on either your call or your put, you don't need just an up move or a down move. You need a big move to get outside of that expectation. So what do we need for a big move? Well, let's keep it simple. A big move versus a small move. Make it binary. Again, it's 50-50. So you need to be the right on the direction, and you need a big move. So what does that leave you with in terms of probability? Well, it's very simple. 0.5 times 0.5, you're looking at a 25% win rate at best. 1 in 4 of these option gambles are actually going to work out for you. You're already setting yourself up to lose to begin with. I don't want those odds. But people trick themselves into thinking that they like the company or they hate the company and they somehow have an edge in that. No, you don't. Your edge is that 25%. So do you want those odds? I don't. Let me do another illustration. Let me dig into a little bit deeper and show you just how bad playing it is. Let's just say that you pick the right direction. Let's say that you win on this one. You have to think about it in terms of a broader trading strategy. if you're just looking at this to gamble, if you just want to do it for fun, I'm not going to go into a casino and yell at people playing the slots that they're going to lose their money. It's not my place. And plus, I get kicked out. But I will tell you that you're going to lose your money doing it this way. And I'll show you why. You have to look at it in terms of a system. Let's take a look at Intel on the day before earnings. This is using Thinkorswim, Think Back feature, great tool. You can go back and look at options prices for any instrument going back years and years and years. I love it. It's great for back testing. So we're up here looking at 722. That's yesterday. And these are all going to be closing prices, the closing price of the stock and the closing price of options. That's what data you have. Intraday, you can get it, but this is all we need because at the close yesterday, we put on this option, hypothetically, to see if we're right or wrong. So let's do both sides. And let's do it two different ways. Let's say that we wanted to bet on Intel going up. All right, so let's just do the closest to the little bit out of the money, just a little out of the money. So closing price was 55.96. Let's buy the 56 call. We're going to use the weeklies. We're just going to do the 1 day to expiration options because we're trying to just play this. That's all we're doing is playing the earnings. And so we're going to take the pretty much at the money 56 call. Now let's go a little bit further out of the money. Maybe we don't want to spend 160 bucks. Let's spend about half that on a 58 call. Okay, so now we've got two options to see what happens. Now, that's if someone was betting on it going up. What about somebody betting on it going down? Well, let's take the next close to in the money call or at the money call, the 55.5 put. Let's buy that hypothetically. And then let's again go 2 strikes away from that. So that's going to be 53.5. Buy that one. Okay, so now in the back testing, we have these, and all we have to do is click up here and see where we would have closed today. Well, over here on the right, the profit loss open. If we would have taken the calls, well, it's no surprise that we would have lost all our money. So that was not going to be good. That fell within that 50% of us being a winner or loser. But let's look at the closing price of if we were right, if we bet on it going down. Well, we spent 147 or 147 bucks buying the close to at the money put, the 55.5, and we only made $105 on it. So what's the problem with that? Well, the problem is we risked, just as if we had bet on it going long. We bet on it going long. We put $169 on that one. Well, we put 147 on it going down, and we made some money. But if we had gone the wrong way, we would have lost all of our option. So that's a full loss, full value. So if we have to take the full value of the option as our risk, we risked $147 and we made 105. Yeah, we got it right, but we didn't even get a one-to-one risk to reward. And remember, what was our probability of success? 25%. So if you only win 1 out of every 4 times, or reverse it, if you lose 3 out of every 4 of these, then you lose, let's say, $150 each time. After 4 trades, statistically, you're going to be down 450. You may win $100 on one of them. Now you're only down 350. If you keep doing this, the only thing you'll succeed in is fun, because that's what you're doing it for, and capital destruction. It's not a good strategy. It's just not. You just don't do it. And hopefully it takes people once or twice to figure this out. But if you look at this from the perspective of a long-term strategy, buying options before earnings does not work. Now, selling premium around earnings, that's something I can get behind because I have done a lot of work and research on those kind of strategies. Those can actually work, doing either a really tight iron condor or even tighter, an iron fly. But that's very nuanced because at the end of the day, anytime you're selling premium, you are picking up pennies in front of steamrollers. And so I don't really particularly like the risk reward, but I won't talk people out of selling premium because it does work for some people. But I will talk people out of buying options going into earnings. It just doesn't work. So don't do it.